401ks, stocks, ETFs, mutual funds, traditional, Roth IRA, 420 Tesla puts on 69. If you're glazed over like a 99-cent donut listening to these terms, then I think this video will help you. In this video, I'm going to be talking about some general investing terms and also go over my opinion of what the most straightforward way to invest is, especially after college. So stay tuned. Hey everyone, welcome to Investing with Kai. And if you're new here, I'm Kai, and here at my channel I talk about things like personal finance, money, investing, with a dash of mental health and self-help. I try my best to cater my videos to my friends' experiences or questions that they've shared with me. So if you're between the ages of 20 and 30 and you have a lot of questions about personal finance, or you're looking for relatable mental health topics, then you're in the right place. Hit that subscribe button and notification bell if you don't want to miss out on new content. And for everyone watching, if there's ever a personal finance question or a topic that you want me to talk about, leave it down in the comments below. I'd be happy to put it on the queue because ideally I'd be making these videos for real problems and real people and not just problems I think people have. And if there's anything I'm not sure of and don't know, I'd be happy to do the research and make a video for it because I know how busy everyone can get. Alright, let's just jump right into it. I'm going to go over a lot of the buzzwords and tell you what they mean, as well as add some commentary from my experiences. So the first section of the buzzwords is the accounts. Accounts are a place where you can put your investments in, but they're not necessarily the investment itself. If you put money into an account but don't necessarily buy investments or stocks, then you're kind of treating it like a savings account, except you're missing out on some of the insurance policies such as FDIC. So the first type of account is a 401k. This is an account named after the tax code and is usually employer sponsored. Most of you likely have one. Usually an employer will match your 401k contributions, the money you put into your 401k deducted from your paycheck, and also put in that match into your 401k. This is a tax sheltered account where you usually have some form of tax benefit for putting your money in it and investing in it. There's also an IRA, an individual retirement account. As you've probably got from the word individual, this is an account that you can open up personally without an employer. This is also a tax sheltered account where you'll get some form of tax deduction or tax benefit from putting your money into it. The last account I'm going to talk about is a taxable brokerage account. Now this account is similar to an IRA where you can open it up personally, deposit money, and then buy individual stocks or funds. Except there are no tax breaks. Any profit that you make in this account, you'll likely get taxed on. If you sell any investments that you profited from within a year of buying it, then you'll have to pay short-term capital gains tax, which is similar to income tax. Or if you sell it after a year of buying it, then you'll pay long-term capital gains tax, which is a lot less than income tax. So next up is talking about the types of tax sheltered accounts. So I just talked about 401k and IRA, which are both tax sheltered accounts, meaning you get some form of tax benefit from investing in them. So there are two types of tax sheltered accounts. The first type is a Roth. A Roth just means that you pay taxes now and don't pay taxes later. And then there's a traditional, which means you pay taxes later but don't pay taxes now. So you can have a traditional IRA or a Roth IRA, or you can have a traditional 401k or a Roth 401k. So the next section of buzzwords I'm going to be talking about is investments. So investments are what you can buy in the accounts that I just talked about. So the first buzzword in this section is stocks. So you can have individual stocks like Google or Amazon, and when you buy a stock, you essentially have a small piece of ownership over this company. And when they profit, you also profit. But when they don't profit and lose money, you also lose money. There's just one thing to note though, that in specifically a 401k or a company sponsored plan, you'll likely have a more restricted list of what you can buy. You probably won't be able to buy individual stocks, but in most other cases, you likely have free reign in the type of investments you want to pursue. And sometimes a certain famous person sitting in a white painted house will tweet something like, "Wow, oil looking good today, smash that like button," and people will flock and drive the prices of oil up. Or that same person can tweet, "Wow, I hate oil. Oil is the worst. We need clean energy, and oil will tank. And even if you are a seasoned investor, statistically, you'll probably lose out to the market average. Most investors do not beat the market average over a long period of time. So you would be stressing yourself trying to pick the right stocks while also making less money than the person who just kind of picked the average. Next, there's mutual funds. And mutual funds are essentially funds that are actively managed and sometimes passive managed. And what I mean by managed is there's a person or a group of people picking stocks as well as the ratio of stocks for that fund. So for example, you could have a big tech fund, and someone could be allocating 25% Microsoft, 25% Amazon, 25% Google, and 25% Apple. That was 4, right? Yeah, that was 4. And whenever you buy into this fund, your money is getting evenly distributed towards these 4 companies. In most cases, it's a little bit more complicated than that, in that the ratios and the number of companies will be much more varied. So yeah. Mutual funds are essentially a pool of money that you dump your money into and someone will manage it for you. And these funds tend to have a fee because managing them takes work. I put work in air quotes because you should always remember what I said about how even the most seasoned investors have a hard time beating the market average. That said, there are funds out there that track broad indexes like the S&P 500 that I always ramble about, and they don't come with as high of management fees because there's not a lot of management going on. They're simply tracking an index that already exists, the top 500 companies in the United States. They rely on those companies making profit, which historically they have. ETFs, exchange traded funds, which are mutual funds in stock form. So you can go and you can put money into a mutual fund like VTSAX, Vanguard's Managed Total Stock Market Index, or you can go and you can buy VTI, the stock version of that mutual fund. Remember that a mutual fund is just a pool of money that you can constantly deposit money into, whereas a ETF is an actual stock unit that you can buy. Over the long term, both of these will perform the same because they represent the same allocation of your investments. But for an ETF, you have to buy them in singular units. So the lowest you can buy is a unit of one stock, or one VTI in this case. There is a concept such as fractional shares, which some companies have developed, but for the sake of this video, I'm going to leave that out for now. Just making sure that you're still awake because I can see how this can be a boring thing, but don't worry, I'm almost done. The last section of buzzwords I'm going to be talking about are essentially the companies. A lot of companies will allow you to create some, if not all, of the types of accounts that I mentioned before. So you could have a Roth 401k with Fidelity, or a traditional IRA with Vanguard, or a taxable brokerage account with Robinhood. And the only difference between them is who you're doing business with. The accounts themselves will behave the same way no matter which company you open them with. Alright, so to recap, there are types of accounts: the 401k, the IRA, taxable brokerage account, and then for the tax sheltered ones, you can have traditional or Roth, where traditional is you pay taxes later but not now, and Roth is you pay taxes now but not later. And then there are investments that go in the accounts like mutual funds, ETFs, individual stocks, and then bonds, which I didn't talk about in this video. And then there are companies that you can open the accounts with, like Vanguard, Fidelity, and Robinhood. So now that I've gone over a lot of the buzzwords and terms, as well as some of the companies that you can do business with, I'm going to be talking about some words of caution and also the most straightforward path for someone who wants to start investing, especially after college. First, you should always check the expense ratio on any fund or ETF that you buy, especially in your 401k, because you're forced into some limited options because some of them will have very high expense ratios. If they're charging you anything above 0.2%, I think they're ripping you off, which means that they're taking 0.2% of your invested money every year as management fees. For reference, VTSAX, Vanguard's managed US Total Stock Market Index Fund, has an expense ratio of 0.04%. So if the market average can be 0.04% and tends to beat most managers or most funds, there's no reason why you should pay anything above 0.2%. I think that's a total ripoff. You should always avoid that. And if you have the choice, I think there are always better options. And speaking of options, you should always avoid options. Now, I didn't talk a lot about options in this video because I don't think they're necessarily beginner friendly, and they're technically not investing and they're more on the side of trading. But for the most part, if you don't know what you're doing, and even if you do know what you're doing, it's somewhat gambling. So when someone yells YOLO 420 Tesla puts on 69, what they're doing is that they're betting that Tesla will drop below $420 before June 9th. And if that doesn't happen, that contract or that option expires worthless. So you lose all the money that you paid for those contracts. Now, for the actual tips, the most straightforward investing technique that you can do as a beginner investor straight out of college at your first job, or someone who just hasn't invested before and is trying to start investing now, it would be in order of priority as you can afford it. One, the first thing you want to do is always get your employer match on your 401k. This is literally free money. If your employer matches up to $3,000, up to $5,000 a year, you should always try and get that match, because even if you withdraw the match from your 401k early and take an early withdrawal fee, you're still getting guaranteed profit from the match. So there's no reason to not take that match. Next, you want to max out your IRA, which in 2020, the limit is $6,000 for the year. This can either be a traditional IRA or a Roth IRA. Although I do personally prefer a Roth IRA because my 401k is a traditional account, and I want to diversify my tax strategy. The reason why I think you should prioritize maxing out your IRA before your 401k is because they're both tax sheltered, but your IRA has more options and you're not limited to certain funds that might have really high expense ratios. Next, you want to max out your 401k, which for 2020, I believe the limit is $19,500. And this is because although you are limited in your options of what you can buy and invest in, the tax benefits are too good to pass up. Also, there are loopholes that let you withdraw from a 401k early without facing early withdrawal penalties, which I'll go over in a different video. Lastly, if you still have money after maxing out your 401k and your IRA, you should open up a taxable brokerage account and invest in something like SPY or VOO, which are ETFs that track the S&P 500 index. Note that you will have to pay capital gains tax, but if you hold your investments for longer than a year, you only have to pay long-term capital gains tax, which isn't as bad as income tax. Well, fireworks. Please stop. Just trying to wrap up my video. Well, this is all I had for this week's video, but if you liked the video and you enjoyed it and you felt like it was valuable to you, please smash that like button if you haven't already, and if you know someone who would benefit from this video, please share it with them. Again, my goal is to just spread the word on personal finance and financial literacy, because I feel like this is something that's not taught in school and that a lot of us are hurting from that. But yeah, this is all I had. It's nice chatting with you guys again, and as always, till next time.